Welcome to today's Corporate Venturing Insider. I'm really happy to have Angela with us. She's Professor of Venture Capital at Columbia Business School. Angela, welcome.
Thank you so much for having me.
So, Angela, I know you have quite the journey into venture capital, teaching venture capital, but could you maybe describe the key parts of your journey into it?
Yeah, so my journey has been one of a path of happy accidents. So I was a founder first. I went to UC Berkeley, I graduated during the first dot-com boom. And so, of course, started a company because that's what you do. And then went on to be a product manager. And then I thought I was going to stay an entrepreneur forever. I went to Columbia Business School for my MBA, and then I graduated and became a McKinsey consultant because that's totally the same thing as being an entrepreneur.
What?
And then re-entered kind of the entrepreneurship space a little bit later. I was an angel investor first, started 37 Angels, which I could talk a little bit more about. And then maybe 8 years ago, a venture capital firm started reaching out to say, you've been doing well as an angel. Would you like to join VC as kind of a venture partner role? But very much not intentional.
Happy accidents, like you said. Actually, I think you're the first one to mention you graduated during the dot-com boom. So maybe you can share a bit of context. Everyone reads about it, but what was it like graduating during that time?
So I think the pros were that it really felt like the world was full of possibilities and literally the internet was being born and new ways of shopping and discussing and interact with people were changing on, a monthly basis. And so it was a really great time to be working and starting companies in such a time of possibility. On the other hand, there was no roadmap of how to do
Mm.
any of this. How do you fundraise? How do you build a pitch deck? How do you build an MVP? None of that existed. So we were all figuring it out on our own. And it was a lot of the blind leading the blind. And so I'm really grateful I started my first company when I was 19 because I feel like I had the exuberance of youth to realize, to not realize I had no idea what I was doing. And I'm glad I had that experience. But I also like these days, I do feel like there are more well-trodden paths, and there are people to say, "Okay, this is actually the right way to write a pitch deck or to fundraise," whatever the case may be. But it was really, really exciting, and I had a lot of friends who became millionaires overnight and then lost all of that money also overnight, and so exciting time to be a founder,
Yeah, it was extremely ups and downs, right?
certainly.
Now, you didn't mention earlier, but you started your first company at 19.
Yeah, my favorite story about that is it was me and, 3 co-founders all from UC Berkeley, and, we knew we were very young to be starting a company, and so we had 3 sets of business cards. I had a business card that said I was the director of marketing, VP of marketing, and chief marketing officer, all of which were true because it was just me running marketing.
Mm.
And, the more senior the client, the more junior of a card we would hand them, because if I handed someone the CMO card, they'd be like, "You should not be the CMO of anything." But if I hand them the director of marketing card, they'd be like, "Oh, well, then my assumption is that there's somebody managing you." And it was one of many things that we did, which were very silly. But again, we were learning by doing, learning by throwing spaghetti against a wall.
I agree, that's a cool hack.
Yeah. I don't recommend it.
I think that's a cool hack. And so you said you wanted to be entrepreneurs forever. So, what was it about the entrepreneur's route that made it so clear to you this is what you wanted to do?
What I love about entrepreneurship is that you see a problem and you solve it, right? And I have always been a problem solver. I also love the fact that there's nobody to tell you, well, you can't do that because it hasn't been done before, or there's this policy that prevents it. I just think that that freedom of possibility is unmatched in entrepreneurship, and it's something that I think should be a part of all businesses.
Now, what's interesting is you start with a problem. That's your first statement is you start with a problem, which I know is a big thing for you and how you teach it. So maybe we can start there. How often do you think the value of starting with a problem is versus sometimes you have a solution and you're still trying to find a problem?
The the bulk of the time, so wild majority of the time, I think you need to start with the problem. I think if you start with a cool technology or a cool product or a cool something widget, and then you try to backwards engineer the problem, I just find that that's a much harder sell. Whereas if
Mm.
you start from the problem, that kind of tells you everything. It tells you who the customer is. It tells you how to communicate to the customer. It tells you where to find the customer. It tells you how much they're willing to pay for it because it's commensurate with the size of the problem and how painful it is. And I just feel like the problem lends itself to a much cleaner path to entrepreneurship than starting with the solution or the widget or the cool technology.
Very nice. Then you moved into angel investment. And I mean, clearly you met entrepreneurs, and I think you were 10 years in the Bay Area. So clearly you were exposed a lot. But why angel investment? What was a trigger for you to get started and maybe some success, maybe some failures?
Yeah. So I wrote my first angel investing check in 2008, which was a really fun time to start angel investing. I wrote a $5,000 check, and it was to a very good girlfriend of mine. She had made a movie that promoted the awareness of mental health in the Asian community. Asians don't talk about mental health. They're like, you're just sad, get over it, right? And I really wanted this movie, more people to see this movie. And so I wrote a $5,000 check. I did not know the term angel investing. I didn't know anything about venture capital. I knew nothing about the space. And I wrote the check, lost all of my money. But then all of a sudden, I was a quote unquote angel investor, and people started finding me and reaching out. And so, for a period of maybe 3 to 4 years, people would send me their deals. And I'd maybe look at 20 deals a year, and I'd maybe write one check per year. And most of those early checks were not successful. And then in 2012, 13, I realized that people need to learn what this meant. And I had learned a lot of this through my own mistakes. And I said, I'm going to get together a group of my friends and teach them what I've learned. And that was kind of the start of 37 Angels.
So there's something really interesting because as you started doing angel investment, you were already very disciplined in only investing one out of 20. I've seen so many get excited so quickly as soon as they see an entrepreneur, which is the way it works. They are trying to really convince you. How did you manage to stay disciplined?
I mean, I did and I didn't, because I also did write a check for the very first company that I saw, right, which was my friend's movie. So that was not being disciplined. But I think that that first jolt of excitement said, okay, I'm going to actually try to be a little bit more thoughtful about it. I am weirdly very risk averse. And so I think just my natural disposition towards risk aversion hopefully did save me some money those first 2 years.
Okay, very good. And then you started 37 Angels. So maybe you can describe what it is and why you started it.
Yeah, so I started 37 Angels with two goals in mind. The first was education, especially in 2012. Nobody knew what these terms meant. So I would go to these conferences and I would literally come home with pages of notes of terms I didn't understand. And I would go home and I would just Google everything. I would talk to everybody. I would ask all these questions. And I very quickly realized nobody knows what these terms mean. And nobody really knows, how do you diligence a company? How do you value a company? So I said, I'm going to try to teach again a group of my close friends, how do you actually do this? And so that was kind of the first problem I was trying to solve, which was, how do I shine a light on the black box that is startup investing? And then the second thing is, I wanted to close the diversity gap. When I started angel investing, I was fairly young to be doing it. I'm an Asian woman, and I would walk into rooms and people would quite literally ask me if I was lost. Or they would ask me things like, where's your money from? Is your husband aware of what you're doing? And just all these crazy questions. So I said I wanted more people who looked like me to be investing in startups. And so 37 Angels, we activate new diverse investors through education.
Okay. And why is the number 37?
Yeah, when we started, only 13% of angel investors were women, and we wanted to close the gap from 13% to 50%.
Oh, that's a good number. Okay, now I get it.
And
So
it's a cool number too. I like the number 37.
very nice. And talk about the performance of 37 Angels. How many investments? What was the returns over time?
Yeah, so every year we look at about 2,000 companies to invest in 10. And so we've invested in about 115 companies over just over 11 years. We have had over 50 investment boot camps that teach people how to do angel investing. We have had 3 IPOs and 16 acquisitions, and our portfolio internal rate of return is over 20%, which is in the top decile of performance.
That's very, very good. And I'm assuming all your investments at seed or even pre-seed level.
Mostly seed. So our requirement to invest is that you have 6 months of customer data. It doesn't always mean revenue, although usually it does mean revenue, but, so that tends to be seed stage. Although we do a little bit of pre-seed, we do a little bit of Series A, but kind of the fat part of our bell curve is in seed stage.
Okay. And I can see you became even more selective because you moved from 1 out of 20 to 1 out of 200. I mean, 10 out of
Yes.
2000. So how was that journey into becoming even more selective?
Yeah, I think part of it is just as your name gets out there, you just get a lot more deal flow. And as you see more, you recognize more what good looks like, what not so good looks like. And we developed our diligence rubric of what we look for. We have the 4P framework: people, problem, progress, and price. And there are a lot of folks out there who are raising, who maybe shouldn't be raising, angel and venture capital, or who aren't ready yet. And so it takes a lot of no's to get to that yes.
Okay. And you said the 4 Ps are people, product, progress, pricing.
People, problem, progress, and price.
Okay. Many of the investments opportunities sometimes is like freemium. It's free to start. So does that mean that you wouldn't invest? I mean, do you mean pricing in terms of unit economics or do you mean something else?
Price for us. So people is obviously the team has relevant domain expertise. Everything looks good there. Problem is it's a large market and attractive competitive landscape. Progress is that they have a repeatable customer acquisition machine. They know how to acquire customers. And price is deal terms. So the valuation of the startup, what does their cap table look like? All of that stuff. Yeah. So price between the founder and the investor.
Okay. So it's interesting because so for progress, even though it's seed investments, you do want to see that 6 months of customer data. You want to see how they are moving along their de-risking, I guess.
Yeah, so we always say that, you know how to go out and acquire customers, and so you know that you do Instagram ads, and for 1 million impressions, you get this many clicks and this many customers, and so you have a customer acquisition cost and you have a customer lifetime value. I think until you have that ratio, you are not ready to raise seed funding.
So maybe the tough question now. As you are invested from 37 angels, if you had seen yourself when you started at 19 years old, would you have invested? Yes or no? And why not?
100% no. And the main reason why is because we were a services company. So we were essentially kind of an outsourced tech consulting firm. We were helping people with Java programming and Oracle DBAs. And so because we were a services based company, we were not scalable. And so was not venture backable, nor did we try to raise funding at the time.
Okay, I understand.
And it's interesting. I would argue 20 to 25% of the companies that pitch us, what I tell them is this is a great company. Go and run it. Don't raise any outside capital. Own 100% and just go build a really profitable company. You don't need to raise outside funding. And so I think that people think that angel and VC funding is the only way to get grow. Absolutely not true, right? You can grow through customer revenue. You can grow through grants. You can grow through debt. There are so many alternatives to angel and VC funding.
It's a golden nugget. And I love it because I keep saying it to many entrepreneurs I meet, including from France, where I said, unless you're planning to go very fast and you want to grow fast and you want to be very risky but potential very high outcome, don't go for VC money. And it's always surprised them coming from a VC to tell them that. But I think there are many, many good companies, very good business models that are just not venture type returns.
Absolutely. People get very excited watching Shark Tank, and I think that's the only way to grow.
Well, I think Shark Tank has huge amount of bias, and I think it's all about show, of course. So they have to show something interesting. So I think they have also a bias on who they select to present.
For sure.
So, what is your own bias as an investor? What it is? Clearly, you talked about people, problem, progress, pricing, so that's built into your bias. But when you meet the team, what it is that you're watching out for?
Yeah, so I think we have different biases by the different P's. On the people side, I have a real bias towards data-driven learners. And so I really like people who are data geeks and who know their numbers backwards and forwards and who are using data to drive decisions. And so the good news is they tend to be more disciplined around their growth and they're really looking at their numbers. I think potentially they sometimes are going to be less innovative and saying like, "I'm just gonna try something," even though all the data says that's not a good idea, right? And so I think that's one bias I have. And I think another bias I have is, I didn't come up with this, someone else said it, which is like hustle, not hassle, which is I like good salespeople and all, investors want that founding team to be a good salesperson. But I do think that I have a visceral reaction for people who go too far down that salesy path, and sometimes they are fantastic founders, but I think I also think, do I wanna, work with this person for the next decade? Do I potentially wanna sit on their board? And really, really aggressive salespeople, I think I have a bias against.
I like this. Hustle, not hassle.
Yeah.
Okay, this is really good. Very, very good. And so then you moved into teaching venture capital. Oh, no, no, you went for venture partner. So maybe you could explain what is a venture partner and why did you choose to become one?
Yeah, so venture partner, I don't know how many people used to watch the Smurfs growing up, but Smurf was a term that could mean anything, and I'm dating myself at this point. But venture partner is also a term that has no meaning. And so, for example, I know of one firm where they have quite literally thousands of venture partners, and I think it's just everybody that they know, right? That could potentially help their portfolio companies. And then I know firms that have 5 venture partners and they sit on the investment committee and they have very clearly defined roles. So, all this to say, there is no one definition of venture partner. All it means is that you work with a venture capital firm and you're not full time. But some people really help with deal sourcing. Some people really help with diligence. Some people really help with post portfolio support. It really depends. The roles that I tend to really gravitate towards are ones where I'm quite involved in diligence. And that's probably the, and then probably post investment support, I think is also really interesting. Deal sourcing is something that I do naturally because of everything that I do on the angel side, but I really like diligence and post-investment support. Those are probably my favorite parts of the job.
Interesting. So diligence is all about decision making. You're looking at a proposition and decide if it's going to fit or not. And we talked about your bias for people. When you look at a deck, what is your biggest bias? So you haven't met the people behind it, you just look at the deck. What it is that is like, no way, and it's like, wow, okay, I want to deep dive.
Yeah, so the first thing, it's such a basic thing, is literally, do I understand the deck? And I know that sounds like such an obvious thing, but I am shocked at how many decks I get where I read, I'm like, I don't know what this company does. I know what industry they're in, I know kind of generally the problem they're trying to solve, but they could be solving 10 problems. I cannot tell from reading this deck which problem they're solving. And so what I always tell founders is, pitch your company to 10 people who don't know you and give your pitch deck to 10 people who don't know you and ask them, what does my company do? And if they can't do that, you haven't pitched the company well. So that's the first thing, is just literally, do I understand what they do? A fun statistic is that VCs look at a pitch deck for like 3 minutes before they decide if they're going to take a meeting. And so it needs to kind of really slam you over the head of like, this is exactly what I do. So that's the first thing. Do I understand it?
Mm.
The second thing I look at is the team page. Is this the right team? Do they have something that makes them understand this problem better than any other team? And then I look for traction, right? So I am looking for rapid growth. And then I would say finally, I am looking for a deep understanding of the customer.
Like an unfair advantage from like the founder market fit concept.
So it's just something unique, right? It could be that they have strategic partners that are going to help them to penetrate this market better than anybody else. It could be that they grew up in the industry and so they know everybody in the space and they're going to be able to sell into their first 100 customers really easily. It can be that they have some interesting distribution channel that no one else has thought of. Like, I don't care what the unfair advantage is, but there has to be something that the team has that is going to let them win in the space. Because if it's a good idea, I've been pitched that idea 10 other times.
Yeah. But I really like your advice on the entrepreneurs showing their deck to 10 people they don't know, but not pitching the deck, but asking what is your conclusion from reading it? Because otherwise, you're actually not really listening to what someone who hasn't met you will interpret the deck.
Exactly.
Yeah.
And, sometimes I hear founders say like, "Oh, well, you don't get it," right? And I'm like, "Yeah, but if I don't get it, customers aren't going to either," right? And so if I'm taking, half an hour out of my day and having a conversation with you at the end that I don't understand, do you think a customer is going to understand at the end of 30 minutes? Probably not either.
Yeah. I think if someone say you don't get it, I think that's a bad signal already. Yeah.
Yeah, if you don't know something well enough to explain it simply, you don't understand it.
Yeah. Yeah. That's very fair. Now, you also mentioned you like the post investment support. So, this is after you've decided to invest from your diligence. Why do you like it so much?
I think I like it so much because I think something that is I think unique in the ecosystem and something I really try to do is founders ask me questions all the time, and I try to not always, but I often answer it saying, "I'm gonna answer your question wearing my investor hat. I'm gonna answer the question wearing my professor hat, and then I'm gonna answer my question wearing my founder hat, or what I sometimes call my human hat." Right? So a
Mhm.
question I get asked all the time is, "Should I sell?" Right? We got an acquisition offer, should I sell? And I'll say, like, as an investor, I'm just gonna walk you through, like, mathematically, what do I as an investor want and why maybe your board isn't gonna let you sell, or maybe why your board isn't gonna encourage you to sell, because they need to understand the investor's incentives and how they're motivated.
Yeah.
As a professor, I just have access to wide data, and I can say, a third of the time this happens, a quarter of the time this happens. And I hope that I have a wider remit of data than other people might. And then the founder slash human hat, a lot of the times, like, it's how tired are you, right? Like, how exhausted are you? Do you have 4 more years of gas in the tank to keep doing this? And I find that that is something I really enjoy having that conversation and truly showing that I'm on the founder side and having that empathy. I think is something it's hard for founders to have unbiased advice because usually people have something to gain, right, from one answer or the other.
Yeah.
And I think that's a really great way to add value post investment. And I like having that conversation.
I actually love the way you're framing it because it allows for disclosing your own incentives. As an investor, that's what I would really like to happen. As an entrepreneur, that's probably what I would think you should do. And and I think that's a really good way to frame it. I really like it. There's one thing I want to double click because when you say as an investor, but what happens is as a company raise money, you start to have multiple preference tags. And then the incentive starts to be different even within the same investors on the cap table. Do you mind explaining this a little? Because I think that's something most entrepreneurs may not understand that as they stratify their cap table, they start to have very different incentive for the investors.
Yeah, so these are these terrible things called liquidation preferences. And so the first thing to recognize about these liquidation preferences is the seniority of the capital. And
Mm,
so debt is the most senior. So let's say the company gets acquired for a small amount of money. The first person to get paid back is debt,
mm,
right? And then it is the later stage investors and then early stage investors. So your Series C investor is going to get paid back before B, before A, before seed. And then you have common shareholders on the bottom, which is your founders and your employees. And so this is why you see these terrible headlines. I just sold my company for $200 million. I, as the founder, got nothing.
yeah,
And the reason why is because your investors, the people who have preferred shares, get paid back first. And there are two ways that we get paid back. One is as a multiple of our original investment.
mm,
And the second is as our percentage ownership. And I have seen certainly, companies exactly that happen. The company gets sold for some amount of money and the investors get everything, or worship only the Series B investors get paid back and nobody else gets paid anything. We were in a situation like this recently where that would have happened. And I find that founders don't always understand how they work. And so, I teach um, like 1,000 students a year. And I mostly teach venture capital at Columbia Business School, but I would argue 40% of my students are founders,
mm,
just like who want to understand this math. And I all the as even though like my primary job is to teach investors, I am about to do a workshop tomorrow, literally going through this with a group of founders so that they know what to look for in a term sheet. And then, of course, please, please, please just don't sign anything without having a venture lawyer look at it. And if your venture lawyer can't explain simply what a clause in a term sheet means for you, you also need to get a new venture lawyer.
That's a good advice. I think intuitively, let's say you sell a company for $200 million, you had raised $300 million. I think it kind of is intuitive that the entrepreneur wouldn't get anything. But this multiplier you mentioned could be an entrepreneur raise $100 million, sell for 200 million, and still get nothing.
Exactly. Yeah, and so the multiples again, they're 1x, 2x, 3x. And so if someone has 2x liquidation preferences, exactly what you just said, very simplistically, the investors are going to get everything and the founders going to see nothing of that 200 million.
Now, clearly not good for entrepreneurs in this scenario, but there's a reason why there is this multiples, which is all about risk-adjusted valuation and terms. Can you make the case for and against these multipliers?
So there are two times when investors receive these multipliers. One is in a down market, right? So in 2010, we saw people giving away a lot of these because otherwise you wouldn't be able to fundraise. And so if you are in a cash constrained market and there's more demand for capital than there is supply, the investors have a higher negotiating power. The second time is where you're in an industry where the upside is not as robust. So if you're in an industry like ed tech, right? Ed tech is something that I mean I could talk for a long time about. As a teacher and as a human, I desperately want to invest in more ed tech. But at the end of the day, there's tremendous exit risk in ed tech. The exit multiples are not that large, and there are very few acquirers. So that means if I have, $1 million, I can invest it in an enterprise software company or I can invest it in an ed tech company. I know that the likelihood of success for that enterprise software company is much, much higher than for the ed tech company. And
Hmm.
so as a result, I have to protect my downside. And so you will see these liquidation preferences being given away in industries that have less robust exit outcomes because the idea is you have to protect the investor's downside. Otherwise, they simply wouldn't invest in that sector. They're going to invest in more potentially rosy sectors. And so that's the argument for liquidation preferences.
Yeah. Now, let's talk about your exposure to corporate VCs. And I've heard you talking about corporate VCs, but you probably were exposed to them both as an entrepreneur, um, angel investor, and of course, you meet with them, I'm sure, in your class as your students. What's your view of corporate VCs and how do you think they are evolving over time?
Yeah. So corporate VCs are in about a quarter of all venture deals. And so it's important for all of us to understand because whether or not you work at a corporate venture capital firm or not, you will invest alongside them. So I think we'll start with the pros, and then we can talk about the cons. So the pros of corporate VC is strategic value add, right? So if you are, like, I'll give you a great example of ZX Ventures, which was AB InBev's corporate VC arm. They don't exist anymore. But they were really good at helping beverage companies with licensing and distribution, which is very difficult in the US because it's all mandated on a state by state level and it's expensive. There was another one that they actually would help you. It was a life science VC, and they would help small companies get access to a wet lab, which is also incredibly expensive. So there's so much strategic benefit that can help on the corporate VC side. The other thing is it can open a lot of doors for strategic partners, right? So if they have relationships with Fortune 500 companies, that can open a lot of doors, and that could be fantastic. I also find that there is usually less governance tied to corporate VC checks, and so they're much less likely to sit on your board. And VC VCs on your board can be very helpful, but it can also sometimes be a little bit hindering as well. So I think those are the pros of corporate VC. The biggest con I hear is speed,
Yeah.
which is that corporates tend to not move at the pace of VCs and entrepreneurs. And so sometimes they can hold up deals. That can be one. And then the other thing is it can constrain your future fundraising and exit paths. So if a corporate VC does lead your Series A, Sometimes in their term sheet, they can put in like a first right of refusal, which means that your Series B has to be led by them. And maybe from an exit perspective, they get to be the first ones to put an offer on the table. And so you're kind of like really getting in bed with the corporate in the long term. And that could be another downside.
Yeah. Now, I think the downside. So first, I think the conclusion from what you just said is yes, Mr. Entrepreneur do look into corporate VC because they bring some value, but be mindful of what you're signing up for.
Absolutely.
And you mentioned right of first refusal, which I think was something that quite a few corporate VC were asking a while back. I think it's decreased, but it's probably not zero. Can you share why this is so dangerous to have this? Because sometimes I hear, yeah, but they are getting value. So the entrepreneurs is getting a potential exit. The mothership is getting some guarantee. It's a win-win. But I think it forgets both the entrepreneurs and the other investors who are investing. So can you share about the right of first refusal and why this is so problematic for a corporate VC to ask for that?
Yeah, if you think about you're at a point where you're ready to be acquired, right? It's very dangerous to have any whisper of acquisition value out in the market. And so, you hear like, oh, whatever this corporate VC is valuing them at $100 million, right?
Mm.
That can really taint other acquisition offers that you might get. That's one. And then I think that there's also just like a feeling of, oh, if they're connected to this corporate VC, then sometimes a different corporate can almost start to see them as competitive. I mean, we had a portfolio company where a corporate VC led their Series A and their Series B, and when it came time to exit, it kind of felt like that was became the only option of who could acquire them.
Mm.
Thankfully, it was a good outcome, but I think as an entrepreneur, you want options. And having a corporate VC have a first right of refusal, it constrains your options. And at time of exit, that can mean lower exit valuations. Or if that deal doesn't go through, well, now you're kind of in a really tough spot because it would have been harder to talk to other people. And I mean, like, it takes time, right? Like, it's not like you have a conversation and you find out in a day that it's not going to work. That could waste 3 months, 6 months of your time. And that is a long time in a startup's life cycle.
Yeah, especially if you discuss it when you have 6 months run rate
Yeah,
left and it takes 3 months to get an answer, then you end up in a very tough spot.
absolutely.
Now, apart from right of first refusal, is there anything that you would say some corporate VCs have misbehaved and they should stop?
I don't know about misbehaving. I do think that a lot of corporate VCs and like corporate accelerators, I would kind of lump into the same bucket. There's maybe like an overpromising where they will say, look, if you come join our accelerator or you take money from our corporate VC arm, that we're going to give you, all this strategic help. We're going to open all these doors. And then when those things don't come through, I think that can be very frustrating for the founder. And I think that happens a lot, overpromising.
Yeah, I think setting the right expectations, not overselling. It's very hard because you do intend to bring all that strategic value. Whether you can deliver on it, that's sometimes actually probably all the time outside your control.
Yeah. I do hear whispers about like corporates doing it as a way to steal trade secrets. I don't see that happening a lot. I feel like founders are very afraid of that. Luckily, I've seen very little of that play out in the real world.
I actually don't think that's true. And if it's true, it's gross negligence because the risk to the mothership is so high.
Totally agree. But I
And
find that founders are very afraid of it, but I don't think
yeah,
they need
no,
to.
I understand the fear actually. I can imagine if you're very secretive of your project and you're talking to the CVC of a mothership that could compete with you in the future, you sharing with them is just, yeah, it feels dangerous. But in practice, I mean, in our case, we have a clear Chinese wall, and I keep explaining to the mothership the reason we have a Chinese wall is to protect you, mothership, because if you end up getting trade secrets, from what we learned from startups, you're the one at risk. And you have to prove a negative in a court. You have to prove you didn't have the trade secret in the first place. It's very hard to prove a negative in court.
Yes.
Now, what is there any CVC that you've worked with or you met which you thought, wow, they have a good design. This is something that others should learn from?
So I mentioned ZX Ventures. I thought they were very clear on the CVCs I think do a good job. They're very clear on their value add, right? So they were
Mm.
like, we will help you with distribution and licensing. I think, Salesforce Ventures, there is a pretty clear path to M&A. So I think that about a third of what they eventually end up acquiring comes through their corporate VC leg.
And they were explicit about.
And it's very explicit, yeah. So I think it's just very clear, like, the purpose of our CVC is to find acquisition targets, or the purpose of our CVC is to make money, which is what I would say Google Ventures does that very well. Or the purpose of our CVC is to um, actually retain employees who have entrepreneurial instincts. So, like Vanguard Innovation Hub, it's mostly Vanguard employees who have entrepreneurial inclinations, but that way Vanguard gets to keep them within the mothership and they get to kind of have a playground to play within to be entrepreneurial with the safety of Vanguard behind them. So I think the firms who do it well, they're ones who are like, this is our very explicit purpose of why we're doing it. And then they follow up and do exactly that. I think the ones who do it poorly are they're like, we do all of these things, but they do everything a little bit.
Setting expectation is critical. Now, I don't know about the Vanguard incubation. Can you share a bit about what they are doing and how they are doing it? Because it sounds like they are doing it well.
Yeah, so it is again, it's mostly Vanguard employees who kind of want to be entrepreneurial, but it's partially a talent retention effort. But they are working on ideas that are going to push Vanguard forward, right? So,
Mm.
how do we think about the next generation of financial education for people? How do we think about the next wave? Like, how do we deal with robo advisors, right? And thinking about that. And so it allows people to be creative and do things that are beneficial to Vanguard, but in a way that they're not bogged down with maybe the bureaucracy of working at the large company, and they're physically in a different space than the rest of you.
Mm.
So it truly feels like, and if you walk in, it looks like you're working in a startup. There's like post-its everywhere. It's very colorful, all that kind of stuff. It doesn't feel like you're working for a big financial institution. So I think the firms that do it well, yeah, again, they're explicit with their goals.
Now, you teach venture capital, so maybe I should ask this. What is a myth of your students believing something is true, and then when they go through your class, they're like, oh, wow, this is not what I thought?
So the first one that comes to mind, and I feel like I should come up with a more interesting one, is that being a good VC is about picking really good investments. And while that is true, it's really important to source good investments, right? If you don't have good deal flow, you can be the best picker in the world. If you're picking amongst garbage, you're not going to get great stuff. And so the idea of this like virtuous cycle of, source good deal flow, pick the best companies, and then really support your company's post investment and that virtuous cycle, I think people over index diligence, 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 and sourcing is such a misappreciated skill. So I think that would be one. I think another one would be that competition is bad. I think founders are really afraid of competition. Investors can be very afraid of competition. And I think one thing that we teach in our class is to have a much more nuanced view of competitive landscapes. There are markets where you can have a lot of winners. And the one I like to use is premium ice cream, right? You can have a lot of winners with premium ice cream. And that means that a wild success in the ice cream space is they're going to capture maybe 1% of the market. And you compare that with enterprise SaaS, where usually the winner is going to take between half and two-thirds of the market. So, like, understanding competitive dynamics is really important as you're thinking about what is a good venture outcome in this space. And it's not just like competition is bad, I think is something I try to disavow my students of.
That's a good one. I think, and it goes with market size. If the market is huge versus small, then it's where the competition doesn't matter as much. I think it was Lei Jun, the CEO of Xiaomi, saying something about even pigs can fly in a tornado, which I think basically means if the market is huge, you will be able to do well. But if you pick a market that's very, very small, then there's so little you can do.
Yes.
Now, talking about sourcing, it's interesting because you picked diligence and post-investment support as what you enjoy the most. You just said that sourcing is actually quite critical. And I agree with that. And I think there's something about entrepreneurs talking to entrepreneurs too. So some of the sourcing you can do once you're a successful firm is entrepreneurs recommending you to other entrepreneurs who are getting started, or having repeat entrepreneurs coming back to you. Can you speak to how you improved your sourcing at 37 Angels, and how you would recommend VC firms to think about sourcing, or corporate VCs as they get started?
Yeah, so I think one is just being intentional about your network. At the end of the day, we are only as good of investors as our networks are strong. And so you need to be intentional and like literally like when I started, I just had a big Excel spreadsheet. Like these are all the people that I know, and I realized, oh, I want. So, for example, I very much started off as more of a digital health investor and an ed tech investor because when I was at McKinsey, I did a lot of work in pharmaceuticals, and I was the chief innovation officer at Columbia Business School, and so ed tech was very much in my blood. And I really wanted to move more into kind of the future of work. And so being very intentional with saying, like, where's my network? Where are the gaps? What events do I need to go to? What conferences do I need to go to? What do I need to be reading? So I think that is the first thing is just being very specific about your knowledge gaps and your network gaps and then spending time to fill them. I think another thing is giving to your network. I think a lot of the times people try to take from their network before they give, and you really, really have to take, I think, years to give to your network. This wasn't something I realized until years later that I had built a really lovely network because I do give to my network. And then I see people on the reverse all the time where I'm like, oh, I haven't talked to you in 15 years, but like, now you need a favor. And that feels very transactional. So I think to not do that, give to your network all the time. And then at some point, those connections will become really, really helpful. And then I think finally, I would say again, be specific with what you're good at. Very similar to the advice that I give to CVCs. I think sometimes I see people just be like, I'm a good investor, right? And really, really broadly, but say very specifically, what types of founders are you good at sourcing? What part of diligence are you really good at? What part of post-investment support are you really good at? And being specific about what you're good at and focusing on that will serve you much better and make your reputation stronger than if you just kind of like broadly try to talk to everyone.
It's very interesting because indeed the quality of your network and how much it trusts you and appreciates you, which is about the paying forward, being a giver, really goes into helping with sourcing. And so, any advice on how to get started with building a good network? I think you gave a few hints, but when you get started, you don't really have a network.
Yeah, I would say the best shortcut to a network is accelerators. And the reason why is because accelerators are these natural hubs where they're bringing together like founders and investors that care about a certain topic. Um, on our website, 37angels.com/accelerators, we have all the accelerators in New York City listed by sector, but then we also have a couple of tools that allow you to search for global accelerators by sector. And I really like them because it's very easy to go to, a demo day event or like an office hours that they're hosting. And immediately you can, so again, I like ed tech. And so Start Ed is a fantastic ed tech accelerator that was as here in New York City. And if you go to one of their events, you're like, oh, here are 25 amazing ed tech founders, and here are 200 really smart ed tech investors. And it's such a shortcut into building a high quality network. And then from there, you want to do other things like thoughtfully reach out, add value, add value to the ecosystem. But I think that's probably the fastest path I think, into networking.
I think it's a great tip, if not hack, but definitively a
Yeah.
golden nugget to kickstart a network of people who are interested into a topic all in one place. I think maybe conferences on a given topic would also attract entrepreneurs in one place.
Absolutely.
Yeah.
It's just sometimes hard, like, if you walk into a room with 700 people, you're like, "I don't know how to do this." Whereas I find that accelerator events are they're, like, small enough where
Mm.
it feels manageable to actually make a few connections that day.
No, I really like the advice. Now, let's talk about decision making, which hasn't come through. I mean, it's clearly part of diligence, but there's still a point in time where you need to decide to invest or not based on the diligence. And there will be times where it's not quite obvious. You could decide yes, you could decide no. What advice would you give for, especially corporate VC, where the decision making is typically very different, consensus based, lot of data? Here, typically, especially in seed or Series A, you don't have as much data, and maybe consensus is not going to help as much. So, how would you advise a corporate VC that's being designed right now to think about the decision making of an investment?
Yeah, so I think you have to very clearly define who, how, and when. So who is I think you need to constrain the who. I think there is a instinct with corporate VC that we're gonna have everyone make a decision. And I think that, Amazon has the 2 pizza rule, which is they don't try to have working meetings with more people than can be fed by 2 pizzas. And I do think that having 25 people trying to make a decision is near and impossible, and frankly, I think leads to worse venture outcomes because it means that you're going to probably invest in the more obvious, less kind of innovative thing. So, constraining the who and, like, being very clear, like, we are deputizing these 5 people max, right, to make a decision. Everybody else, they get to have input, they get to do whatever, but you really want to figure out, narrow the field of who's making the decision. In terms of when, I think you need to have a process in place. Like, we guarantee that from pitch to funding decision is 4 weeks for our founders. And if you don't put a timeline, then things will very quickly spiral into, months and months and months of timing. Because it's so easy to say maybe and to say we need more data. Because at the end of the day, we never have enough data to make these decisions. These are early companies in nascent industries. And so it always feels uncomfortable. We never have enough information. So you really have to get someone who's very good at cat herding. You'd be like, nope, we're making a decision in 3 weeks, 4 weeks, 6 weeks, whatever it is, but to force it. In terms of the how, I do think it's important for everyone to have some sort of rubric, right? So these are the 14 things we care about, and we're going to give each of them a score. And I would really encourage your score to be like on a scale of 1 to 4, not like 1 to 5. And the reason why is because if it's 1 to 5, it's too easy to give everything a 3. But if it's 1 to 4, then it kind of forces people like, do I like this or do I not like this? And then have rules, right? So if more than one metric is below a 2, we can't invest. If the average is below a 3.2, whatever it is, like having some sort of clear thing. And then recognizing that sometimes you throw the rubric out, right? So we have our rubric and we do try to have that. But I would say that so we write 10 checks a year. 1 check a year, I'm like, according to what's on this piece of paper, I either shouldn't be investing or I should be investing, but I'm going to make the other decision because that's what my gut says. And so allowing yourself the freedom to say that sometimes my gut is going to go in a different direction and I'm going to have the confidence to stick behind my gut, but you can't throw out the rubric all the time, right? So like saying like, but every year I get to make two dumb decisions. Is fine, but every decision can't be made off of gut.
Now let's double click on the gut because some would argue it's pattern recognition, it's experience, it's biases. Gut seems to be like a way of saying that's how I feel about something, but I can't quite explain it. But there is clearly something from the past that leads us there. How often do you think that following the gut is the right way to go?
So what I will say about this is it's a little bit different for yes versus no.
So let's split the two very clearly then.
Yeah, so it happens free maybe a third of the time where on paper I'm like this is a good company to invest in, but my gut says no. That time I listen to my gut, right? So for us to write a check, kind of gut and rubric have to be aligned in that case. In that case, my gut is picking up on something, and so the things that my gut has picked up on is like we found out later that one company had um, a criminal record, and it was a violent criminal history, right? And that didn't come up in diligence, but like there was something there. We had another founder that kept telling little white lies, and then they ended up defrauding their investors. So like that's stuff that like won't come up in a rubric, but my gut caught it. I think on the reverse side, when the rubric says no and your gut says yes, that is a harder one to do. And I'm like, I get one of those per year.
It's like a silver bullet kind of concept.
Kind of, yeah, yeah.
So it's interesting. I think what's interesting about venture capital is you clearly need to define your rules, your strategy, and everything. But I feel like the best investments are always going to be a variation of an exception to your rules.
Yeah, absolutely. Because by definition, if it wasn't weird and crazy and wonky, then, we wouldn't have all the cool innovations that we have today.
I really like it. And so, if you were to advise a corporate VC to pick an investment committee, you mentioned earlier five, but what would be your recommendation for an investment committee to be more likely making the right decision? And here, investment committee would likely come from the mothership, where they make decisions very differently than venture capital. How would you advise a wannabe CVC to do a good investment committee design?
So the first thing is define success. What does success for the CVC mean? Is it making money? Is it finding acquisition targets? Is it finding cool people to hire to bring in house? I don't know. There can be lots of different definitions of success. So that once you and you really have to have one primary definition of success. You cannot have 17 different definitions of success. And then based off of that, you want to arm the investment committee to be aligned, right? So if it's really about hiring and identifying talent, right, then you want someone on the team who's really good at assessing talent. If it's really about financial returns, then I would have somebody on the CVC who comes from venture capital who has a good investment track record. If it's really about acquisition targets, you want someone from, the M&A team, the corp dev team. So it's all about saying, what is my success? And then arming people. And I find that a lot of the times who is on the investment committee for CVCs, it's based off of seniority and like politics. And that is not what's going to lead to a good outcome.
So that's a golden nugget I'm hoping people are listening to. It's interesting, when we started TDK Ventures, I think there is a temptation to involve many, many people, simply because companies have many top management people that wants to be involved. And I remember my hack, and maybe it's a hack I can share, is I said it should be 3 or 4, but they have to be in the same time zone. And of course, TDK is a global company. We have so many time zones. And I remember the pushback was, but we could manage 2 time zones. And at that point, I said, yeah, but I'm the second time zone. And so
Yeah.
once you have 3 time zones, it becomes extremely difficult to be
Does.
fast and to react. And so we ended up with 3 corporate officers for the investment committee of TDK Ventures, with only 2 votes yes being sufficient to approve an investment. So we don't need consensus. And I'm waiting, I think I still need to wait a few more years, but I'm going to look at how much of our best investments were 2 out of 3 versus 3 out of 3. I think that would be interesting to look at the data, but it's too early for us to say. We only started in 2019.
Yeah, absolutely. I am also, that is a study I want to run, which is, does consensus driven decision making lead to better or worse outcomes in venture capital? And I have not yet seen a perfect study on that. And so I might have to design my own.
I think it's actually very difficult because most VCs or CVCs don't record whether it was unanimous or not.
I know.
Most VCs, actually, I don't know if it's most VCs, but definitively most CVCs want unanimous. So then you have none of the non-consensus investments data because they actually are not recorded. So I think you really have to be very strict with your documentation of decision. In our case, because it's 3, it's actually very simple. Every decision is either unanimous decline, declined, approved, unanimously approved. So we would always know if it was consensus or not.
Right.
But we don't say who voted what, so we protect the person from that, but we make it clear whether it's consensus or not. So we have the opportunity to go back our last 44 investments and to know which ones was consensus or not.
I would love to see that data when you have it.
Okay, I would be happy to share with you, and maybe we write an article about it
There
at
you
some
go.
point.
There you go.
So I want to ask maybe 2 final questions, but the first one is, if you have the CEO of a company, let's say $10 billion market cap company, same level of sales, so it's not a good multiple, but it's not a small company. They don't have a corporate VC today. How would you advise a CEO to think about whether it makes sense or it doesn't make sense to have a corporate VC?
I think I would ask them why. right? Like what is the purpose of, so don't create one just for the sake of creating one, which
Mm.
we are seeing a lot of people do. Um, and then does this replace anything or is it new? So some people use it to replace R&D, to replace like an innovation hub, whatever the case may be. Um, but it really just starts with, do you have a clear reason for doing this? And if you don't, it probably doesn't make sense. And then again, one definition of success. I think if you can't do that, it's probably not going to be a successful CVC.
It's super good. And I think the why have to be very, very strong. But many times what I've seen is that the why is very strong, but not aligned within the top management.
Very true.
And without that alignment, you're going to end up with troubles. Corporate VC is very hard. Venture capital is very hard. But if you start with a misalignment on the why, you're going to have troubles no matter what.
The other thing that's really particularly difficult with CVC is the timelines aren't aligned, right? If it's a publicly traded company, and people get compensated quarterly or annually, or there's quarterly reporting, it's very hard because venture capital, as you know, has such long timelines, and so the timelines don't always align between corporate and venture capital.
No, that makes sense. What would be, and that's my final question, and maybe it's hopeful, which is what do you think is the role of corporate VCs to help entrepreneurs being more successful? What should they focus on to help entrepreneurs unlock value to society?
That's a big question.
Hmm.
Um, I would say that one is to share the wisdom of past failures. I think a lot of the times people talk about sharing best practices. I think sharing past failures and mistakes is so much more useful, especially for a founder. So that is one. And then I think the second is making expensive things less expensive by giving them a playground. And so if I think that the corporate VCs that do a good really job is when there's something that's very difficult for a small company to do. So maybe it's access big data. Maybe it is to do like something that involves like a physical lab. Maybe that's something that involves doing a pilot with their customers. But they truly take the power of this huge company and they allow the start, because the power of corporates is scale and just massive access to resources. But the power of startups is this like nimbleness and this agileness. And if you're able to marry those two, magic is truly created.
And I think that's where I touch on your last answer, which is maybe that superpower with a very clear why. If you can match the two, that becomes really powerful for the startups they would support.
Exactly.
Angela, thank you so much for your time today. And I think we touched many topics, but I think there was quite a few golden nuggets for the podcast audience. Thank you.
Thank you so much for having me.